Hey everybody, welcome to another free edition of our Trader User Weekly Roundup. This is for the trading week ending Feb 7, 2020. Hey everybody, I'm Preston Brent. Thanks for tuning in. Well, this week's theme, I guess, can be all about risk. The risk appetite is clearly very high. I mean, if we look all over the globe, all the major markets finished solidly in the green. Starting here in the US, the Dow, S&P, NASDAQ, Russell all had solid weeks over 2-3%. Year to date, the only one in the red so far is the Russell. And then globally, we can see that the markets all finished solidly in the green also. The London index, the FTSE, was up almost 2.5%. CAC 40, the French index, up 3.85. DAX, the German, up over 4. The Nikkei, the Japanese, was up over almost 2.7. Hang Seng, the Hong Kong index, was up 4%. It was up over 5% the prior week. China is the only holdout, finishing below water, 3.38%. The strongest sector this week was technology, almost 4.5% up. And of course, the weakest performer was also the weakest performer a week prior. It's energy. It was down about 73 basis points this week. And looking at valuations, we're starting to get a little bit stretched here. The trailing 12-month PE ratio is 26.10. The forward PE is about 19.11. So that's the forward 12-month is 26% lower, almost 27% lower valuation than the trailing 12-month. And then, of course, rounding it up, we got the S&P annual dividend yield at 1.81. The 10-year interest rate sitting at 1.57. So the yield in the S&P still outpaces the interest rates by, almost 30 basis points, just about. So we're going to still funnel money into the equity markets. But again, if, to others around the globe, everybody seems to want to load up on US equities. I mean, that makes some sense because our rates, as I said, are continuing to attract foreign buyers. Our inflation is still low. Markets continue to outperform other global markets. We got strong consumer optimism, sentiment, spending, so given all of that, I mean, heck, what could go wrong? And even some were thinking, well, maybe this coronavirus last week, it was going to be the potential Black Swan, but I guess the coronavirus killed that off itself, at least so far. But like I said, market action this week was very bullish. Risk appetite continues to rise despite a move lower on Friday as a little bit of risk started to come back in. But let me just give you an example of some of this riskier behavior. And we typically see this after the markets have had a long run. You've got very easy money, a lot of liquidity out there. And some of this stuff is starting, and it always materializes to kind of foreshadow just the counteraction to a lot of liquidity and very low interest rates. There's this I saw this in Barron's this weekend, which I found fascinating. Haven't seen it a lot since the 2008 crash, but there's this new speculative paper called PIK Securities. And it's really, it's the similarity, it's like an interest only mortgage payment where you never really pay the mortgage off. You just pay interest. And even then you can refinance the mortgage as long as real estate prices keep going higher. Within these interest only mortgage payments are really a great thing because you can make money on the equity appreciation of the property rather than paying down the debt. And that's kind of like these PIK securities, only some of these companies that issue them don't even pay the interest. They just borrow more debt. And I saw this recent example that blew my mind. There was a PE firm that had invested a lot of money in this private company or this public company. So this company, through this PE firm, issued 450 million in 5-year securities rated CCC. Now, for those of you that don't understand the ratings of Moody's and S&P, they're kind of similar, but CCC is on the junk side. I mean, just really high risk. So the yield was about 12%. But where do you think those proceeds are going? They're not going to pay down debt or for R&D or to invest in the company. Those money collected from issuing that is going right back into the hands of the private equity firm that backed the company. And it's a way for the private equity firm to get their money out, obviously, because the stock's not doing that well. So it's just that type of behavior. I mean, like I said, we've seen that. It was common right before the 2008 financial crisis, but it's a way for some of these money-backed PE firms to get money out, right? I mean, it's just a lot of speculative interest there. which to me is just, it's amazing. And then when interest rates start to go higher, which eventually they will, you're going to see, oh man, it's just the cascade effect is going to be amazing. And speaking of risk appetite, how about Tesla? I mean, we saw that stock double in less than 8 weeks. Now, a double on a 30 or 40 or even a $100 stock may be one thing, but a double on a $400 stock is amazing. And it just it's crazy. And I saw this other interesting stat. If you take the market cap of Tesla and then divide it by the number of cars they sold, at one car per market cap for Tesla is worth $367,000. So that just tells you how extreme it is. Because when you compare it to other auto companies, I mean, look at BMW. One car per market cap sold at BMW is about 17 grand. So that makes sense. General Motors is about 6,400. So Tesla is way, way up there. Now, part of it, I understand. They're completely reevaluating Tesla more as a technology company versus an automobile company. So we're seeing some PE multiple expansion. I guess some is the operative word. How about a ton? But I still think it has a ways to go to come back down again to get more earthly levels. But when you see stocks do these kind of things, kind of like Beyond Meat or Bitcoin when they took off, really amazing how we're seeing this. Now, this past Friday, we saw Friday's monthly job numbers come in very strong at about 225,000. And the expectation was only $1.60, and the unemployment it ticked up 10 basis points from 3.5 to 3.6. But that's on good news because more folks came back into the marketplace. But fears of the coronavirus and everything, the way I'm taking a look at this right now is the minute we see, the biggest fear is not the current death toll. People and markets were expecting the death toll to expand. But think of it like, and maybe the analogy is not that good, but think of it as an inventory of sick people. As the inventory of sick people start to get steady to go down, or people that potentially may be sick, that is going to be the time when, and these numbers start to level off in slight reductions, even though death toll is creeping higher because we would expect that. Then we're going to see the market start to respond very favorably. Also, I think there's like 12 reported cases in the US. We just had one US citizen over in China die from it. But if that starts to expand, it's been on hold right now, but if it starts to expand in other countries, primarily the US, we'll see a little bit more of a sell-off here. Okay. Now, if we look at the charts, right, I've got the Ichimoku on the screen up here. I'm going to continue to go back and reference this chart because it's a pretty good indicator on the candlestick chart I have here. You can see that we're still in a very bullish mode, all right, and we've been kind of staying in this bullish mode here with the red above the blue. Now, for our members, we spent over an hour and a half, almost 2 hours, covered in detail what all these lines mean on an Ichimoku, how they're calculated, and how best to use it to trade. But for this weekly update, just understand as long as the red stays over the blue, that's a pretty good sign, right? And we had a nice bullish entry back here on this daily chart coming back here about the middle of October, and it's been bullish ever since. Okay, so this would indicate as we move forward in time, the risk zone is constantly being pushed higher. So that means if prices don't continue to go higher, then the odds favor getting back into this risk zone, hence more chop. Okay. Now, the other thing, markets are fractal, which basically means that when you look at a shorter time frame, things work from inside out. So you see the adjustments and the reversals in stock price on a shorter time frame before you do on a longer time frame. So one of the best time frames to use for a kind of like an X-ray view of the daily is to look at the 240 minutes. So if we go down to the 240 minute, the chart will look entirely different. Okay. And you can see here on this 240 minute, I had down here as we were moving down with our members, we had a nice 3, 4, 5 Elliott wave pattern. And using Gann extension and Fibonacci extension, that was the projected touch point, and we came right down and hit it. And then you can see, again, on this time frame right here, there was an entry signal right in that area here, that suggested on this 240-minute chart. This was just a couple of days ago, at the beginning of the week actually, where we started to come up, and it suggested you stay strong and long. And you can see over here, there is a red zone and a green zone. So that basically means whether we're bullish or bearish, here is going to be, we can expect more chop. Okay, there are no divergences here, so that does suggest any down move is going to be bought. It's an Elliott wave 3, so we can expect a pullback to form a 4 leg before we move higher and find the inevitable 5 leg. That's assuming we come back down to these levels. If we stop our pullback somewhere here and go back higher and take out that prior pivot high, the 3 will reprint here on the primary wave, and that just means we're going to go even higher. So, you know, if anybody tells you they know for certain where the price action is going to go, then I would walk away from them, because they don't know. But we do play probabilities here in our user group, and we do very, very, very well in playing these things. You can also see I got the fib node extension here, about 1.16. So we found some issues here with this. And I told our members, I said I wanted to at least hold this for the weekend, and we didn't do. You can see here where it provided perfect resistance at that level, and then we broke through, but then we had this kind of almost bull flag looking kind of thing that would suggest we could bound higher. But again, when you've got a binary event like the coronavirus, you've got to throw some of the bets out, and the odds increase for chop until that gets more sorted out. We've got a lot of support down in this level. Again, the next fib node down is 3264. And then I've got this 3220 area, which is where we bounced before. And then below that, we got the psychological barrier of 3000. Okay. But these are the areas that I'm looking at right now near term in the markets. Okay, so this is just something that we want to pay attention to. Now, I will say on a daily chart right here, we have not had divergences going all the way back to this run up here starting in September. I mean, we did have this little bit of a dip here, but we have not had any divergences, you know, starting our run really on October 7th. Okay, on the daily chart, we got a buy signal about the middle of October, and we've been long and strong ever since then. Okay, and notice over here there is no divergence, but look at this right here. If we get further downside like this, then it's going to force the MACD to roll over. If we get a rollover here, that's going to be very strong divergence, which would mean once we get into this chop mode here, we could attempt a move higher, but then the odds favor a rollover again into this zone right here, taking us down to the next fib level. Now, you heard me say 3200 is a psychological barrier, but this is 3189. So right in that zone right there. Should that break, then we're going lower, folks. So the only thing that I see on the horizon that can do that is if the coronavirus expands, or we have some other unknown event that transpires. Okay. Now, if we come over, I'm going to show you another chart using 3 standard D Bollinger Band rather than a 2 standard D Bollinger Band. I like that a little bit better. It gives me a little bit more detail on the expansion and contraction of Bollinger Bands on a chart. So let me just go find that screen here for you right here. It's screen number 6. So if we come over here and take a look at this, I'm going to wait for it to come up on the screen here. You can see, well, I don't know if you can see it just yet, but you can see right here as it's printing on your screen, we hit all-time highs here of 33.57 when we bounded above that fib node, and now we're coming back down. You can see the low for 2020 down here, right? Now, if you look at the fib node here, this yellow line is the central part. Typically, in almost all bullish modes, and when you've got a strong bull market, the markets tend to climb between the 1 and the 2 standard dev levels from the central point in the middle of a 20 EMA. So you can see here as we're moving up, it's just perfectly moving there. Then we move back down, and now we're seeing this thing here. So I'm going to look at this central part here around, call it 3,300, just slightly below, as a a catch basin. I want to see that thing hold up. If it doesn't, then it could get a little bit uglier. And then one other chart view I want to show you is more based on volume over price. So if we look at this volume over price chart, let me find the screen for that. I think it's screen 5. So, and when we look at volume over price, it just prints volume at different price levels. So it shows you where and this chart will also show you where the maximum amount of volume is. And you can see here, these yellow lines here, here, and here is the max volume area. So these areas tend to be where the bulls and bears really duked it out for a long period of time. So typically when markets pull back, they go back to where the last resistance area of the bulls before they finally capitulated, and then bears or bulls or bears depending on the direction of the move. It'd be bears if it was bullish, and bulls if it was bearish. So you can see here, and you can see right around the 2019 price, which if we go below this level will be in the red again, is sitting the 50 EMA. So that could be, and I had said 3220 roughly, and that was an area that I had called out right in that area right there that we moved down to. So that'll be just looking at a daily chart how I'm seeing this thing. But then if we break this area, then we've got a little bit of a hold point here right around 3120. That's where we had a lot of volume take place in this area, but it's usually a range. It's not one specific price. And then next below that is the 200 EMA sitting at about 3022 to 3000. You can see in this zone right here, we have another strong area of support. Okay. Now, what would that entail from a pullback perspective, percentage wise? So if I were just to come in here and let me put my let me find it here. Let's see here. Where is it? If I were to look at my where'd it go? Here we go. If I were to look at my tools here, let me just do a pullback from the highs here. So if we were to come down to the 200 EMA, that's right around a 10% pullback. That would give us right at almost a correction. All right. That's about 330 points off the all-time highs. And we would still have the bullish mode intact, and buyers would probably start to come in pretty strong. If we take it down to the 50 EMA, not quite as far from the high all-time highs, about 3.75%. If we come down and retest the lows now that we're a little bit higher, that'd give us about a little bit more than a dip. It'd give us a little bit of a pullback, about 5.16%. So these are very doable, guys. Not out of the realm at all. And all it would take is for the markets to perceive the coronavirus as expanding, and this leg up here that's given us this possible divergence in the MACD, it could fire off and take us back down into this zone down here. So that could be a very easy thing to do. So we're going to look at next week as a little bit more of a risk off, be a little bit careful in where the markets are moving. And of course, if we look at volatility, and I show you the VIX here, you can see here the VIX just slightly higher from where it closed the prior week. Okay, it closed the prior week right on the verge between our green and our yellow zone. It closed in the yellow zone here, sitting, slightly elevated at 15.47. Remember, what you want to get in the habit of is when the markets are pulling back really hard, watch volatility. If volatility stays subdued, then that's not a bad thing. It just means it's just, it's not panic selling. It's just profit taking. There's not much to be seen to it. So I'm going to look for markets to stay kind of in this range from a volatility perspective. And if we look at the bond market is continuing to drive up in this area here. Remember, I was telling you guys last week, I said I'd be more interested in shorts than longs in the bond market, but it's continuing to move. I'm looking at analyst reports that say that bonds can go higher, interest rates can go below 1%. That would be the 10-year. So this will be really interesting to see how the Feds react to this. Interest rates are already fairly low. Bonds have moved up in this level up here. And we're going to need to see a little bit more of a risk on kind of appetite. The bond market right now and the equity markets do not agree. Bond markets are very high. I mean, on Friday, it was up over one full handle. Okay. And you know, when bonds go up, interest rates go down. And if we look at interest rates, if we look at the 10-year rates, okay, look at the regression channel on here. We were in a nice steady move higher, and then when this broke, it really broke. We came down to this hard level of 151, and if we take out 2019's low, which was last year's low, we came in and we made new lows for 2020, obviously, but 2019's low was what 1429. If we take that out, we're near all-time lows for the 10-year U.S. corporate bond, and that is going to damage the equity markets, because the equity markets then surprisingly will be a little bit more fearful of interest rates that low. Okay. Because the bond market may know something the equities don't. And for our members, you always know, I love the bond and the interest rate markets. You've got to understand them. You don't have to trade them, but you need to understand them, because that determines where the equity markets want to go. Think about it. Liquidity and credit is what drives a capital market. It covers everything from a corporation: their cost of money, their use of funds, whether there's money out there to borrow to do what corporations need to do, or it starts to dry up. And once it starts to dry up, interest rates go higher and corporations are stuck, and then their balance sheet and income statements really take it. So we want to make sure, and right now credit in the bond market is fine. Even the highest grade junk bonds, the triple Bs, interest on those is only just a few basis points, about 300 basis points higher than investment grade. So that's still very good for high grade junk bonds. Okay, although seeing some of this stuff like these PIK securities, as I mentioned, triple C at the lower end of the junk area. Money's trying to find yield, and they're going to go everywhere to find it. So if the markets start to unwind, those guys unwind first, and everybody else gets hurt when it starts. Okay, look at the U.S. dollar, guys. U.S. dollar. I mean, we've just bounded higher. I had two regression channels I was tracking on here. You can see this upslope that really started right at the beginning of January, and we made a series of higher highs and higher lows. And all of a sudden, back in when the markets really started showing a lot of strength in this past October, in Q4 of 2019, the dollar was selling off with a series of lower highs, lower lows. But then when we've got the coronavirus starting in January, here we go. We took out prior pivot highs. So with a stronger dollar, that's going to tend to put downward pressure on the commodity market and on large international corporations. Stronger dollar hurts them a little bit more. But money's coming to the U.S., so it's really hard to prevent the dollar from getting weaker, really. I mean, it's going to take Fed action to do that, which I don't see happening right now. The Feds are pretty much on the sidelines so far. And if we look at the euro is, you know, staying down and coming down to where we saw lows in 2019. Look at that. I mean, it's just boop, 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 like that, right? So the euro is continuing to get weaker because Europe is still in the doldrums. I mean, just big time. That's why money is pouring from Europe and Japan into the US. Now, Japan's a little bit different, though. Look at Japanese currency, the yen. It was coming down through Q4 of last year because it's a risk on, risk off kind of gauge. And now it's staying down this area here. So this does seem to suggest that global markets may find a corner and move higher, but it bears a lot of close watching, okay, on the yen. And then, of course, if we come down here and we look at gold, right? As I've told my members, gold's going to be in a sideways chop action here a little bit here. If the if the coronavirus really starts to bite into the U.S. equity market, we'll see gold move a little bit higher. Look at palladium. This is one where we didn't quite get up to where we wanted to get to. And you could see on this daily chart here where it's rolling back over just a little bit. So if we take out this low right here, I think palladium is going to go a pretty good bit lower, right? I mean, it just got, it's too exaggerated. there's a lot of buying right in this area right here. So if it breaks it, then the next stop down is going to be another 100 points down with Palladium, and then probably down in this area, down in this area here. I think eventually Palladium is going to find its way back down to the 1800 level. That's more normalized levels. We didn't get a bearish divergence on the trade, but we got what I call a poor man's bed right in this area here. So on Thursday, it went hard down, and then we got this little hammer here, which looks like it could move back up in one last gas before it rolls back over again. So we'll take a look at it and see. But look at nat gas, everybody. I mean, nat gas is just getting killed. Let me just, well, before we get to nat gas, one other one. Look at copper. Here's another one that got killed on China. I mean, look at copper. It's one of the worst performers, one of the worst commodity performers in January. Okay. And we had a signal to go short right at this level right here. And what we did was we basically over in this area here, I went long Freeport-McMoRan, and I suggested to our members to go long Freeport-McMoRan FCX. That was a really great trade. Some of our members took the trade here. Now you can see here copper, as long as China stays weak, China is the biggest buyer of copper, it's going to stay weak as well. Okay. And if we look at Freeport-McMoRan, let me just find it on the screen here. You can see right here with Freeport, it's doing a lot of skipping around, a lot of gaps up and down. We got a signal to go long Freeport-McMoRan in October of last year, and that was the trigger. You could have picked it up at about $9 a share, right? And even with this huge pullback, it's sitting at 11.80 a share. So on a relative percentage basis, that's a great return. But anything lower than this, it could be setting up for another potential buy should they get that virus all settled into. Okay. Now, if we look at oil, let me take you over. Oil is another one like copper. Look at oil. Even worse performer for 2020. I mean, look at it all the way down. And the primary reason, of course, is China shutting down all their factories. A lot of U.S. companies are shutting down their U.S. factories that they're participating in. Airlines aren't flying there. Logistics companies aren't going into ports like they used to before. So all the oil demand is just crushing. And once you get down at these levels down here, a contrarian play by selling puts out of the money or doing long oil could make some sense, but not yet. Give it a little bit of a chance because you can see the 2018 closing price, 2019 lows around the 45 area. I could see oil coming down into this area if the coronavirus accelerates. And then oil is going to be a wonderful buy, not longer term, but playing a counter trend move higher. Okay, that to me would be great. So, but not right now. I want to wait and see. But look at nat gas, everybody. Nat gas has come unglued. Nat gas is also like oil. There's plenty of inventory, but factory shut down, less usage of nat gas. When there was already an overabundance in inventory, it's really ugly. If we come down below 161, that's going to take nat gas down lower than it's been for decades. So obviously, the cure for very low commodity prices is very low commodity prices, just like the cure for high commodity prices is very high commodity prices, because producers, depending on whether it's cheap or expensive, either cut or increase production to maximize their return. So when it's very cheap, they cut production to reduce inventory levels. And then what happens is a sine wave effect to when you do need nat gas, production's been cut, so price action drives prices higher again. So you get this cycle or this wave, over 3 or 4 years that can last. So right now we're in the wave where it's just coming down. But because it's a binary event, the coronavirus, and some fear in the markets due to that, then we may have a pretty strong counter trend move. So that could be some opportunities that we're going to be taking a look at here. So members, I will see you in our chat room this Sunday evening. If you're not a member of our group, highly encourage you to come in and check us out. I think you'll enjoy it. Make some money with us. This year is going to be a real interesting year. I'm still bullish longer term, but I think how we get there is going to be different than 2019. We're going to remember in 2019 we did not have 10% pullback. Not one correction. I define a correction as greater than, well, I don't. The market's defining a pullback More than 10% is a correction. So I call a dip less than 5%, a pullback between 5 and 10, and then a correction between 10 and 20. And of course, greater than 20 is a bear market. So this is kind of where we're sitting right now, guys. Members, I will see you Sunday evening in our weekly market watch. Everybody else have a great weekend. Come on in to the inside and join us. We're having fun this year. Everybody, take care. Ciao now.